So can everyone see the presentation?
Mm.
Yeah.
All
Yep.
right, so I'm Tyson Halsey, Income Growth Advisors. This is our somewhat monthly call. I have Mitch Bulajic, Chang Qiu, and Charles Zhang will be speaking as well. And I'm just going to quickly go through what I'm looking at. Then either Mitch or Chang will speak, and then Charles Zhang will and then we'll open up for comments. But I like this idea of a new investment paradigm. Jeffrey Gundlach of Double Line, I think, is one of the most astute analysts out there. And he kind of said things are different, things aren't acting the same way. And I believe that that's true. And he kind of pointed to the weak dollar. And I think that the weak dollar is operative in how assets are valued. And I think that that's part of the reason we're seeing stronger gold, stronger silver. Commodities have not universally broken out, but I think that they could do very well. I think value and small cap also should do well. Welcome, Walter Harrison. I came across this chart, and it's consistent with my thinking that things are at a extreme, and this shows the valuation of equities versus commodities, and it's shown as a ratio, and it got to an extreme in 2008 and in 2000 when there was the tech bubble, and I feel like this is more like a tech bubble. It hit another extreme in 1990 and during the energy crisis. And what this would imply is that we could start to see the performance of commodities start outperforming equities. And this is after a period where commodities have not performed well for a long period since, let's say, the financial crisis. And that's my story, and I'm sticking to it. One way that I kind of put my brain around it is what I call an inflationary or commodity cycle, and this is a sequence that or a chart that basically shows that there are inflationary and deflationary environments. And since 2008, we have been in a deflationary environment. Equities have done extremely well, but during the period from 2000 to 2008, during the 70s, gold and oil in particular did well. This is basically the S&P divided by the PPI or a log of it, but it's based on, in part, on the idea that commodities and equities tend to be negatively correlated, which is consistent with inflation. Here is the Shiller-Cape ratio, and you also have overlaid on here the 10-year Treasury yield. But what you can see today that stocks are extremely expensive. They're over the 1929, the 1966 highs, below the 2000 peak, but not far from the 2020 peak before we had a little decline. But at 37 times, stocks are terribly expensive. They were about 6 or 7 at the bottom in 2008. And Treasury yields are right now at about 4%. And to me, that's really uninspiring. And in fact, I think that we've grown up over the last several decades looking at the 60/40 and owning bonds as just the anchor in a investment portfolio. But in recent years, this is from Bank America, the 30-year Treasury, and that's not all treasuries, that's the longest duration Treasury, they've done lousy. You've actually lost money. And that's important. And that's important here, particularly when you think of who are the big players in investing. And when you look at foreign central banks, they now own more gold than they do US Treasuries as a percentage of their foreign reserves. That's pretty extraordinary to me that you're getting central banks buying gold and they're starting to eschew US Treasuries. US Treasuries in the last 10 years have been downgraded by 3 different rating agencies. And, when I think about what the interest rate risk is, the inflation risk, and the credit risk, 410 for 10 years for that doesn't get me very excited. And I don't think bonds make sense. Stocks make sense either. So for that reason, you're seeing more money go in and invest in gold. I played around with some charts. I've looked at the past moves, and typically they're on the order of 500%. And from the bottom and projecting up 500%, you can come up with a price target of $6,500. My intent is to stay long this asset or plays on this asset until I see it start to turn. And maybe when you start to see the 200-day moving average on that commodity turn down, then you might want to get out of it. But I think that there's an important lead lag factor between gold itself and gold miners. And gold miners make money selling gold that they mine. But for 14 years, this whole sector was out of favor. Nobody touched it. And now gold mining stocks are starting to catch fire. And you can chart the ratio of the miners relative to gold, and you can look at it and hear my colleagues over at Crescat Capital. You can see that downtrend, that ratio is starting to turn up, and that would suggest, and I believe, that you could see a protracted period where gold mining stocks do well. That's certainly my hope. That's where I have invested some of the money that I run and my own money. But here's an interesting way to put a quantitative measure to it. The GDX is the gold mining index, and the price earnings ratio for that index, and this is from UBS, the PE in 2017 on the GDX was 22, which is about where the S&P 500 is today. Today, it's around 12. So you've had a significant decline in the PE multiple on gold stocks. Gold itself is going up. Their earnings are soaring, and they're fundamentally cheap. There are a lot of other places in the stock market that have compelling stories, but this, to me, makes a lot of sense. You want to buy something cheap that people are starting to move into, and has a fundamental driver, and that driver is that gold prices appear to be going up. Now, there are a lot of things that could support my thesis that gold should do better than the market in general, and fiscal and monetary decay, political realignment, a paradigm shift, moving away from the 60-40 and having a much higher portion of commodities. Jeff Gundlach said on an interview last week that he thought a portfolio should have 25% gold, flat out. He's a very sophisticated guy, and that's a big allocation, and it really surprised me. I think that typically institutions own about 1 or 2%, or family office assets allocated only 1%, and maybe it goes to 2%. So for him saying 25% is pretty extraordinary. Many of you know that I like a company called Blue Lagoon. They are a transition company, a company going from being a resource company to a operating miner. It is my belief that they will start blasting today. They got their license. They raised their money. The stock had a nice run from November of last year when it was less than 10 cents and got up to 64 cents. And currently it's around 47 cents. But as soon as they start blasting, they'll be able to start taking the rocks from the mine and start stockpiling them and then shipping them down to Nikola, where I expect that they will start pouring gold, as they say. And I've made some estimates in terms of some commentary that they have published about doing 100 tons per day, growing to 150. And I would come up with EBITDA on the order of $3.3 million for the fourth quarter of this year, and $8 million in revenues. This is a $70 million market cap company. But I see this stock, potentially, if the news is good and the momentum again catches hold, getting as high as a dollar this year. And as they really start to increase their production and maybe start to examine opening additional mine portals for them, it would double in next year and then continue at that very rapid pace where I just see this stock by the end of 2029 being as high as $4 to $6. And the numbers that I did this not just the back of the envelope. I have spoken to all the geologists and the people working there. I even spoke to a guy by the name of Steve Cutler, and he was head of mining operations over at Stillwater of Sabine Stillwater. They were bought in 2017 for $2.2 billion. So he's very familiar with this property. And I was like, well, I really like it. Quentin Hennig over at Crescat says this is a potentially very large opportunity. Is that credible? He said, well, I'd worked on the mountain before. And yes, I think if there's potentially a lot of gold below the surface. We've got about 1 million ounces above us. And I think that as they start doing some drills in the second quarter of next year, they'll be able to really start to quantify the gold below it and open those additional portals. And he said that he thought 400 to 500 tons per day is doable in the 28 to 29 timeframe. So, I'm taking company guidance and talking to people. And one other person that I've spoken to is Peter Espig. And Peter Espig is a shareholder, but he's taking all the offtake. He owns Nikola Mining, and they're going to process this. And he took 5,000 tons in 2021 and processed it and sent them a check for 1.6 million, which, by the way, I think gold prices were about $1,800 an ounce at that point. But he's kind of given me some insight into the way things will ramp in terms of what the production can be. I've spoken to Sid Rajiv, who wrote a report on it. He was saying, he thought only 100 tons per day, and he'll be putting out some updated guidance once their commercial production will begin. But I think that Warren Buffett allegedly said that what he tries to do is what Wayne Gretzky attributed to his great successes. I try to skate to where the puck will be. And in my mind, owning a company that has a tremendous resource, that has tremendous, a compelling high-grade resource with significant potential that is now going to start generating cash flow so that they not only are productive on an operating basis and profitable, they'll be generating free cash flow where they can do the drilling to really measure out the size of this resource. And so, as you know, I own about 4.5 million for my clients and myself, and this is me. And I'm going to end this slideshow here. Oh, stop share. I knew there was something I needed to do. And Chang, can I ask you some questions? Have you speak?
Sure,
Then
sure.
we'll go to Mitch. So there's a lot going on. We have a president who wants to change things, and the relationship we have with China is. I'd love you to share your insight. Chang has worked at a hedge fund, and he gave me some brilliant ideas back in 2003. All these companies ultimately went up 100-fold: NetEase, Sina, Sohu. And he is Chinese and highly credentialed. Anyway, go ahead. Tell us what your thoughts on China, and then we'll go to Mitch and then Charles.
Okay, thank you, Tyson. Last Friday, President Xi and President Trump finally had a call, and in the call, basically, uh, China acknowledged, U.S. helps during World War II in defeating Japan, or in the victory of the anti-Japanese war. And also, she also agreed to basically give the control of TikTok to the U.S. Investors group, the control of the algorithms as well. So that's kind of like I think is a good gesture, or is a in terms of it's a good improvement in terms of a sentiment between the U.S. and China. And after that call, in China's announcement to the domestic people, they in China Daily or Renmin Daily, they have a whole article basically acknowledge U.S. help during World War II, during the Chinese anti-Japanese war. And I think that's a good sign. The on September 3rd, China have had a military parade to celebrate this 80 years the 80 years anniversary of the victory over Japanese. And at that occasion, President Trump, basically in his Twitter, he said China should thank U.S. But in the formal address by President Xi on that day, he mentioned that, thanks for the help for a few foreign countries, but did not specifically mention U.S. So this article after the phone call with President Trump, formally in the kind of like national media acknowledge that help. I think that's an important indication of at least they want a good relationship with the U.S. Over actually the last few months, the China names actually performed quite well. That's in a sense, I kind of thinking that's as long as the U.S. is not, or China does not view each other as enemy, obviously China equity will normalize in terms of valuation. The last few months, China AI names, they just go up like just like in U.S. They are quite, I should say, quite crazy. Even some of the China cheap semiconductor names going quite good. But on the other hand, China's economy is, I think, still struggling. The recently released number, like the youth unemployment, that's between 6 years old and 24 years old. The unemployment rate of that age group is like 18.9%. That's setting a new high. That's even excluded the college students. So the real rate actually is even higher than that. And that really gives China, in a sense, more trouble ahead, because right now China is, the birth rate is quite low. And those younger group, if they don't have a job, which means they will prolong their marriage will be delayed. The everything basically going afterwards. If they don't have a secure job, they won't have more kids. Even after they marry a few years later. So I think that's in terms of longer term, that's a big problem. On the asset side, you can see China, even right now, the Shanghai and Beijing, the housing, the apartment sales the volume is very low. The price started dropping. Last month, actually, Beijing leading nationally in terms of a month-over-month drop in price. The car side, I think everybody noticed Warren Buffett just sold out a BYD last week. The China EV is kind of like the overproduction is quite heavy, quite in a sense severe. There are many domestic reports of price competition. Many basically you sell a car and you lost on each of the sales. The employment side, the further problem is many of the small company going under because China last month they tried to reinforce the collection of Social Security contribution because many small company when they hire people and they just tell the employee, I give you this salary, but I won't contribute to the Social Security funds. But that loophole, the government tried to basically close that loophole. And many of the small companies, they, once if they really pay that Social Security, they basically cannot really pay a relatively good salary to the employee themselves. So that's one of the reasons many of the restaurants get closed, and many of the small business they don't want to hire people, or even they just hire older people that they won't need Social Security. So in a sense, the export side also, I read obviously to the U.S. that's down in last few months. To Europe, from the indication like the shipment price also recently is weakening. So there are some worries of the GDP growth for the next 2 quarters. And the government looks like this week and they announced like 500 billion of policy support for the economy. So that hopefully that will help a little bit. So overall, I think if you guys judge, the U.S. and China relations is going to improve. Obviously, I think China names are worth investing. Otherwise, I from my standpoint, I kind of thinking the relationship right now looks like on up and down, kind of a fluctuating situation. If they view each other as an enemy, I won't want to invest in this space.
Thank you. Yeah, I don't think markets give when the largest economies in the world are at potential war, and certainly things have been a little dicey and concerning. Thank you for that. Mitch, tell us, what is your take on things?
Can I share my screen?
Oh, yes, I got to learn how to do this.
I like to talk infographics. It's easier.
No, I like it, but you ask me every time, and it's like I forget every time. So Mitch, as you know, has worked as a quantitative and macro strategist at a couple big hedge funds and does quite a bit in the AI space, and he can elaborate. But he is now going to share some of his insights. So,
do you see my screen?
We do see your screen.
Can you tell me what does it say, just to make sure I'm
doing
the right
tight.
thing?
Okay,
yeah.
Investment grade spread since 1998.
Yeah, I'm just going to very quickly talk over a couple of subjects. Spreads, bonds, AI, China, gold, just a couple of, but trying to look at it, I'm trying to avoid subjects that are overly populated lately and trying to look at a different point of view. Credit spreads. All right, so very tight and unexpectedly tight. Market wasn't predicting in this macroeconomic environment would be this tight, but what does it really tell you? It's fine. You really believe in this? You better stick to really high grade quality corporates in this situation because the tail risks become very, very high. And as you can see here, what we've been looking at before, every time there's some big problems coming in, these spikes tend to be dramatic. Another thing to watch, speaking of, going into the fixed income market and credits, bond volatility. I'm primarily an option trader, and I'm a big believer in looking at volatilities very often precede the price move, as they call it. This is the equivalent of VIX for the 10-year bonds. Move index is very critical, and it spiked up during the Fed hiking cycle. Now it's moved down a bit. Why is this important? Credit spreads, because credit spreads basically, when the move index starts moving higher, actually start really going wild. So and there's a few other reasons why you should be watching the bond volatility index, because basically it's pretty much a lead and correlated indicator with the VIX and the SPX, as you can imagine. So if we get to see one of those bond volatility move spiking or moving higher, it pretty much can cause damages all around. It's starting with the credit spreads, but also overall the equity volatility and the equity pricing as well. Okay, let's move a little bit on the tech sector, kind of tech AI overlay. I've been talking, this is something I've been talking for a while about undersold and undervalued Chinese tech, overvalued US tech. And this spread it's still there. The spread is still there. Selectively, there's been a lot of outperformance. But for instance, picking up Alibaba was a pretty good deal because Alibaba year to date is up 112% and Nvidia is up 33%. And Alibaba is one of the three that I was focusing on since the beginning of the year. Speaking of Nvidia, I don't know if anyone's familiar that their capitalization now is greater than Canada or UK or France or Germany. Okay, only India, Japan, China, and US have greater capitalization than Nvidia. I'm not going to talk about Nvidia's tail risk. I mentioned that before, but if you want to buy Nvidia here, you probably don't like money then. So another reason why spreads between US and China tech are actually a good deal, not just because of historic spreads, you can call technicals, money flow, whatnot, but because one thing, and I would like to hear Chang's opinion on this, is that the level of speculative money in China has actually gone up dramatically, margin buying and whatnot. It kind of goes counterintuitive to kind of depressed consumer state in China we've been hearing, but I'm just talking numbers here. This is not narrative. I'm just interpreting the numbers, and that's a very big positive that you'll have a lot of speculative money in China, not just globally, coming in and picking up cheap Chinese tech. Again, if you want to be risk averse, what I did, I went short NASDAQ, went long China tech. So basically right now, pretty much a little bit up, no big deal, but that's probably the safer bet if you really believe that China's going to stumble. But if China stumbles, I don't see how NASDAQ is not going to stumble either. Okay, let me move into AI. This is really what I do for a living in a way. So we're looking at the underlying real GDP growth. So if we excluded the tech spending, we would probably be flat. Now, I don't want to translate how would that translate into where the S&P will be today. You never know. But tech spending, pretty much the mega 7 capex for AI. Okay, so then you got to say to yourself, you really, to expand this rally, you will need to have parabolic capex coming in. And we know right now that's not going to happen, not even parabolic at all, because what is really the problem? Now, bear with me here. I'm going to actually focus a little bit going into the future. How does this work out? if CapEx is the big catalyst, and if these prices, including S&P and everything, is based on that, let's take a look at the AI cycle. So generally, can you see my mouse pointer? Is it visible?
Yes.
Okay, good. So generally, in my view, what the CapEx now we're getting from the big seven is right here, with the assumption that we are like at the peak inflated expectations. The problem is on the demand side. The demand side is pretty much here now. And this is what I've been hearing in the last week. There's a lot of issues. Who's going to be actually, where's the earning going to come from? Where are going to be the buyers? I think this is the big disconnect between the supply that think that we are here and the demand, the corporate world that's pretty much think that they're here. Now, I'm a big believer in AI. Productivity is going to through the roof. And plateau of productivity, I think it's much better than what Gartner imagined here. But right now we have a short-term problem here. Okay, long-term, which means any kind of market crashes or AI stock kind of retreats, whatnot, you probably could be a buyer. But this is the real big disconnect we are talking about. Just to mention another thing related to AI. Before I go to the next graph, there's also another disconnect going on in Wall Street and London with AI. I think just incredible lack of knowledge of Wall Street and London analysts of how to actually incorporate and value AI into the company. And we're not talking about a minor thing, so if he gets it wrong or misses it, doesn't matter. We're talking about sectors that could have a revenue and margin impact from 30 to 90% on AI. And it's going to happen very fast. So this is one of the big problems. They're not really understand how to actually make this valuation. Second problem is that a lot of focus is on the supply side. And that happened all the time. Everyone's talking about NVIDIA's and Microsoft and whatnot. But if you look at this cycle here, this growth cycle actually, eventually after we go through this disillusion phase, it's really the corporate world, the Main Street that matters. We had that with the 80s with computers. Dell, everyone's talking about Dell and blah, 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 and it really didn't matter. What mattered was the next 10 years. Who from the Main Street, the demand side, is going to be incorporating how much the actual computers? And that's where you had the big difference between companies who didn't and who did. That's where the growth was, not with Dell. We can go in the 90s with the internet revolution. Well, we know what happened with Cisco when everyone's saying, that's it, they're going through the roof, whatnot. And I'm not saying that that's destiny for NVIDIA, but, you know, if China does come up with something, well, maybe NVIDIA will have a Cisco destiny. But that's the real second thing. No one's really looking at demand side. That's the long-term picture. And we're going onto the corporate American, figuring out who's getting it right, who's not, because this is not just that your growth is going to get enhanced by AI. Growth is going to be tremendous. But this is really like a gaming theory 2.0. It's not every winner takes all, but kind of it does. Because if you have companies that are going to grow their margins by 100%, 200%, most of this is going to be not AI, but because of AI, they took someone's lunch and someone had to file bankruptcy. That's what's going to happen. And that's the reality that's waiting us next year or two, which I think is also missed. When I mentioned that things are going to happen fast, that's what this chart really tells us what happens, because the trajectory of a computer internet AI adoption is dramatic. We are like 2 years, not even 3 years in, adoption rate is already 40%. That just tells you how fast things are going to happen, which means winners are going to happen overnight, losers are going to happen overnight. That is why at this point, the supply side's priced in. That's not where the profit is. It's on the corporate America you got to focus on. Who's going to get it right, who not. And it's not next 10 years like with 80s or the 90s. It's going to be next 2 years. Okay, that's where the difference is going to be made. Just a little quick chart on this. This is performance. Up here on the top, we have NDX and AIQ. AIQ is like an artificial intelligence index. pretty much correlated very closely with Nasdaq because it has the Mega 7 and has really the high cap top. But the real players and the real AI companies going to make a difference from robotics, next phase, next 15 growth areas of AI are actually, you can find them in some of them, not all. I'm not in total agreement with how these ETFs are structured, but you will find them in robo and bots. These are the two ETFs. In my view, this gap is going down dramatically. So that's something to keep an eye on. I'm not giving stock picks here. I'm not in full agreement that all the companies in these two ETFs are really assembled properly, but it's a good benchmark. Okay, lastly now, just move on to Tyson's favorite subject is gold, and my favorite indicator, volatility. So gold has volatility too. It's called GVZ. That's the gold volatility. Why is it important? Because again, when volatility picks up, gold goes actually parabolic. Okay, so another spike of volatility. We didn't see it. Last time it was in April 2025. But if we see the spike in volatility, we can talk about gold going past 4,000. It's a good thing to watch. If gold volatility starts picking up, that's the time to go. Now, in parallel to that, the implied volatilities on a relative scale are very cheap for gold, believe it or not. So if you're seeing volatility spiking and the option premiums are cheap, that's the best speculative play you can have in mind. But again, whatever you do right now, shorting gold is not a good idea because we're living in a totally different cycle. Last subject, Japan. This might be a coincident correlation, but Japanese 30-year yield and gold are in full alignment. I don't know if gold is telling us something about Japan or Japan is telling us something about gold, but it's a very interesting correlation because we also have to really keep in mind this is the reality. Japanese yields are going up big time. Okay, and US here on the right side is low. So it's like the yield differentiation eventually have to kick in. And if you keep in mind, and these are the charts, they're really, again, this should be like the spread trader's dream come true. But if you look on the left side, you have the 10-year US yield. This is the German bond 10-year yield, and then the Japanese. The gap is really narrowing down. But then again, I'm not saying there's a direct correlation with the currencies, but if you look the euro dollar is pretty much going up and down, a really tight range if you compare it to the Japanese yen. They've been actually surging against the Japanese yen. So there's not a direct correlation, but this chart here on the left, absolutely, even though there's not direct correlation, doesn't justify the chart on the right. So again, I would be very cautious selling the yen against the euro and the dollar in this environment. And that's pretty much what I dreamt up last night, and I quickly put on a graph here from me.
Thank you, Mitch. That's great. Charles Zhang, you've got a lot of quantitative trading background, and let's see. Can you unshare your screen, Mitch? There you go.
I'm trying to figure out how to do it. Can you do it I can't figure it out.
Oh, look at this.
Oh, okay, I see it. I got it.
Is that you, Charles? Charles, you're on mute. Right.
Okay, here we go. Okay.
Is that you with Filter the Reality and Rise?
Yes, that's mine. Yeah, that's mine.
All right. Well, fire away, and then we'll do some Q&A.
Well, the market currently is extremely euphoric. So psychologically, kind of you almost have to tune out any fundamental analysis and just focus purely on short-term momentum. The strongest stock right now tend to be story stocks because they're not constrained by fundamentals. Therefore, I don't think there's much value in talking about these stocks. So I want to talk about something that's a little different. I recently listened to a podcast that completely shifted my perspective, and I want to share with all of us. This podcast featured a successful Chinese investor. He had an incredible story. from being a broke new college student to becoming a renowned growth investor. So of all the lessons he shared, two powerful counterintuitive messages stood out. The first key message is actively ignore bad news. It's a waste of your time. So now I know that sounds crazy, right? We need to be realistic, and we also need to understand the world's problem, right? Well, his answer is a firm no. As he puts it, it's useless because pessimistic news does not give you opportunity. Think about it. So constantly consuming content about economic downturn and societal anxiety, what does it really provide you? It gives you fear. It gives you reason to stay put and avoid risk. In short, it paralyzes you. So instead, you want to be relentlessly seek out like good news. Find out like which industry are growing, like talking to people who you know that are suddenly like making more money and ask them how. So like filter your information diet to feed your store of success, progress, and opportunity. Because opportunity is where the good news is, that's where the energy is, and that's where you want to find the next wave to ride on. His next message is perhaps like more important, is to use artificial intelligence in every aspect of your life. So he compares the rise of AI to the rise of the mobile internet. That was a revolution that unfolded over 20 years. So completely reshaping our world. Most people underestimated it at first. They either resisted or thinking it's a passing fad. This investor thinks AI is a similar 20-year large trends, and most of us are underestimating its impact. So now you might be thinking about the stock market, about the hype, about the volatility. He makes a crucial change here. He says AI stock might be a different story. They could be a bubble, but that's the key. The underlying technology is what matters. So thinking back to the dot-com bubble in 2000, I mean, these stocks crashed spectacularly. But what happened to the internet? It kept on growing. And the company that survived and adapted, like Amazon, went on to define the next 2 decades. So the same applies to AI. The real opportunity is not just about investing in the right stock, it's about using the technology. So this investor, he has some advice for everyone. So if you're an employee, become the person in your company that knows most about the AI tools. If you are a creator, use AI to edit your video, transcribe your audio, and supercharge your workflow. And if your job has nothing to do with AI right now, he says you should be tossing and turning at night, not able to sleep because you're likely in the wrong industry. So let's bring it all together. Like two simple, powerful ideas. First, curate your reality, tune out the noise and negativity. Focus on the people, trends, and news that shows you what's possible because only good news creates huge opportunities. Second, don't just observe the AI revolution, participate in it. It's a 20-year or longer mega trends. So learn the tool, integrate them into your workflow, and let that tide lift you. Technology is the trend, so not just the stocks. So the only thing that's constant is change. So by choosing where we put our attention and our energy, we decide where we get either we get washed away or we learn to surf. That's all I had to share today. Back to Tyson.
Thanks, Charles. That sounds very interesting. I think you really it is easy for people to get consumed with the negatives and Minaj, would you care to offer some perspective? Just tell the audience here a little about your background. Minaj is somebody that I met through Marty Sakata's Ivy Family Office and is I want to say, a quantitative macro guy. And please give us a few minutes and then we'll go to some Q&A.
Sure. Yeah, thanks for having me, Tyson, and nice to meet everyone. So I'm Manoj I'm the founder of 93 East Capital. It's a global macro fund. now with a track record of about 4 years. Initially, it started as an incubator and then raised some friends and family capital and sort of in the process. But my background really is 20 years on the buy side. I worked as an equity research analyst for a bit, but spent most of my career at JP Morgan in a group called the Chief Investment Office. This is the part of the bank that invests the bank's excess capital, free capital. That's about, when I was there, about 300 billion in assets, and now it's closer to 600 billion. So over there, I spent most of my time as initially as a housing analyst, and then I helped manage an equity investment portfolio, and then was an economist. Subsequent to that, so I was an economist for the group, and subsequent to that, I spent a few years at an insurance company portfolio, helping manage their investment portfolio. It's also about 10 billion in assets, and then about a year at a macro hedge fund. So very interesting discussion. Thanks for having me. Really, enjoyed the discussion on gold, and also, Mitch's points about yields, which so I do write a monthly newsletter for my LPs, and you're all more than welcome to subscribe to it on my website. I guess the point I was making is that I wrote about the rising yields in May, and the way I looked at it was, obviously Mitch had those charts of yields going up, but I looked at it from a Z-score perspective, and you can really see like I thought it would be a huge risk for markets, which hasn't panned out. But the rising yields, to me at the time, and probably still are, a risk that's out there. But then, maybe kind of stick with Charles' philosophy of looking at the bright side of not, sort of being too pessimistic. But I'll stop there. I said a bunch of things that introduced my background and talked about the discussion as well. Sorry if I went over.
Well, you've
but,
run
yeah.
billions of dollars. Where would you be putting money? And you said you thought my comments were interesting. Do you agree that there could be a significant shift towards gold, or any other takeaways really jump out at you?
Yeah. So, I mean, right now my hedge fund is pretty small and growing, and I have been in a position where I sat in multi-billion-dollar portfolios. So, just to sort of in terms of like answering your question, I think Tyson, one of the things like when you're setting large portfolios, right, is that it's hard to be if you're sitting sort of in a family office, or like to Gunlike's point, I saw his interview as well. It's sometimes just hard to get so much confidence in a asset that's traditionally been considered speculative. And I see the fundamental reasons for it, and I would be invested in gold, obviously. It's just that sort of an excess allocation to the extent of 25% might be sort of a little bit aggressive from a some sort of a traditional portfolio, right, with its multi-billion in assets. Now that said, all these sovereign funds are multi-billion in assets, probably trillion, right, and they're moving towards gold and away from liquid treasuries. So I think, as you say, don't fight the Fed, don't fight the central bank, don't fight the sovereign fund. The rally could keep going. And I agree with many of our points. And I guess for me at this point, I'm trying to figure out where the risk is. As we all should, right? When you've seen this huge rally, in AI and gold, and one idea is to kind of stick with it and write it out, and maybe ignore the short term, like, maybe 3, 4, 5% drawdowns, and then just stick with it for the next several years. I think a lot of it is making sense to me. And, all your comments, I definitely agree with all of them. But when we're in this position, now I'm trying to figure out where the risk is, just as sort of as an investor, investing client capital, right? I don't know if that answered your question or.
Well, we're all not absolutely sure of anything, but we're just trying to have a thoughtful understanding of things. Walter Harrison, you're on mute. Do you care to offer an opinion? We can't see you, Let's see.
Okay, hold on. Here we go. Hold on.
All right.
All right.
There you are,
Yeah.
up there in Saratoga.
Well, Lake George, New York, upstate, founding of our country. And I'm actually leaving tomorrow to go back to Florida. At any rate, another way of looking at what Charles talked about is just the market climbs a wall of worry. And so as long as people don't get it, and there still, I mean, as you know, given the money that's been made, it's ridiculous how low the sentiment is versus the good sentiment versus the bad. Obviously, I've been my two biggest positions haven't changed. They're energy and gold, and I can't believe what happens with the gold. It's going crazy. But sort of a side thing is that people are worried about the independence of the Federal Reserve Bank, and the Fed is nothing. I mean, the act was passed in 1913, and in 1914 it went into existence, and its sole purpose was to protect the purchasing power of the dollar. Now, fortunately, we were still on some, sort of these modified gold standards going into the Second World War, and there was no net inflation. But since then, the 1913 dollar is now worth 3 cents. I mean, so it's taken people a lot of time. And one of the reasons, of course, is, that after they had the big rate cut initially, which should not have happened, the 10-year yield went up because, it was premature. And even now, it's bounced slightly, and inflation is still a real issue. So, I don't know what happens. The good news is regarding the market that unlike back in 2000, the earnings of this Mega 7, are significantly more than they were, than the NASDAQ 100 back in 89 and 90. So it's not really quite as crazy as it looks. Having said that, I'm a long-term value investor. I've only got one modest stock in that area. And I'd like to think, obviously, that the commodities are going to shift as Tyson is thinking. And, I suspect it'll work out. But, we live with uncertainty. And I can understand Minaj's desire not to, to get out on a limb. The good news is I'm only managing my own money, so I don't have to worry if it ever goes back down again, as I used to with the hedge fund, because then I had all my friends in it and they didn't understand necessarily the fact that there's always going to be pullbacks. And I can't believe that there hasn't been one yet. I guess that's it. Tyson, is there anything else you want me to think about or talk about?
That's great. Well, I want to add a couple things that I heard. Kathy Wood's ARK Investment had a CFA luncheon last week, which I attended, and the director of research talked about the opportunities that he saw in their and Kathy Wood and ARK Investment. They really focus on what they think are the disruptive areas of change. And I had brought a friend an investment advisor there, and I told her, I said, "Wow, that guy turned me from bearish to bullish," because what the problem with tech is, it's hard to understand exactly what it is. You can think it and you get the buzzwords, but when this guy really explained how AI could be applied to autonomous driving, and he just went on sector after sector, how it works with, um, it was very compelling. And so, and right now we're in a period with the Fed's easing, so you don't want to fight the Fed, and uh, so I've been pretty negative on the Magnificent Seven, but then they turned around and reversed, and they've gone to new highs. So I think that Charles's comments are apt, and again, at the end of the day, you don't want to really be short the market unless there's a compelling reason. And right now, the Fed's easing. The market responds to easy money, and it's getting easier. And anyway, anyone else have any thoughts? Mike Portnoy, Neil Winward.
I have one thought, which is I love what Charles said about that growth investor. The attraction of bear porn is just very compelling and must be avoided because it's not productive and it means that you miss the right tail risk, right? So, but I mean, in terms of what there is to worry about, I mean, when you say, bringing down interest rates makes it easier, it makes it easier primarily, first and foremost, for the Treasury, because interest expense is the biggest cost now, and we're not showing any signs of being prepared to cut. We're interested in cutting defense or Medicare or Social Security. So if you're not going to cut, then you have to get the rates down, and I think you see that more and more with more being issued at the short end to take advantage of that. And I think at the long end, the only thing they can do is effectively find ways to step on the yield curve. And I think they're going to do that with, easing bank reserve requirements, enticing the banks to buy the longer end. And I think that's all incredibly bad for bonds, which I just wouldn't want to. I think those are the most conspicuous risk. And maybe there are trading opportunities. I'm not a trader, but I think that's all incredibly bad for bonds. And I think all of those things are being reflected in gold and the other monetary debasement play, which is Bitcoin. And I think one thing which is remarkable to me, I attended an independent investor conference a couple of weeks ago, and it was heavily attended by Gen Z and millennials. And there is an enormous allocation to crypto and to Bitcoin. And I think it's a reflection of the perception that because we all have the assets, right? Boomers have the assets, and they're gradually going to be passed down. But people with assets have profited nicely from inflation, which has found its way into assets. And so for Gen Z, crypto and Bitcoin represents an asymmetric bet, and it's a way for them to participate where clearly the only beneficiaries of running the economy hot are those who have assets and can benefit from the ongoing inflation of asset prices. So those things I see more and more in more and more conversations. I mean, it's sort of not. And the other thing to Chang Qiu's point is, I think and China hawks won't like this, but I think the US is in the process of bending the knee to China because they see very clearly they can't go to war with China when 75% plus of their defense and military supply chain is held hostage by China. I mean, even more for gallium, right? It's 98%. So, I mean, Hegseth has said we have no interest in conflict with China. He said that to his opposite number. And I think it's very clear that Russia and China between them can outproduce the US militarily. And you see that in Ukraine. So, that's a very good reason not to go to war if you can't win it, right? So those are some of the things that I see going on.
I agree. That's very thoughtful. Any other final comments? Mike Portnoy, William Root, Susan Lee. We'll wrap it up. It's been an hour. Minaj, I think you talked about Operation Twist. And I think if you've listened to Gunlock, the idea that short-term rates going down might mean higher long-term rates, but you could get whipsawed if they go into that Operation Twist. Care to elaborate, or we can just wrap it up now?
Sure, yeah. And actually, PIMCO had an article on this last Tuesday, I think, and I can email it to you if you want to send it around, or you can just look for it. But I think that's an absolute risk. And the other risk also is inflation remaining sticky, where yields stay high. And I just sort of come back to my thesis is that, the current administration, the Treasury Secretary is being sort of an activist Treasury Secretary, as opposed to maybe some of the others, his predecessors being less activist. I mean, they're always sort of political entities, but my point was that the idea of yield curve control has been sort of in the background for a while. And I think as they get ready to shape the next Fed in whatever format it might be, rightfully or wrongfully, they're going to start focusing on that, getting the long-term low, the long end low, and with the idea of reducing mortgage rates, with the idea of reviving housing. And I think that the point where it's coming from is, I think 2 or 3 weeks back, the Treasury Secretary wrote an article in the Wall Street Journal talking about the importance of housing as a sort of a social need. And the way to get that moving is to basically get mortgage rates low. And the way you get that is getting the long end low. So I think they're going to attempt it. Whether they're successful or not, that's obviously a risk. High inflation is a risk, but I think they're going to definitely attempt it. And I can go on, but yeah.
I have a question. I have a question for you, Manoj. Well, in general about I know that's probably Scott Bessett's attempt, but like Japanese were so and so successful in a deflation environment. How is U.S. going to accomplish that in an inflation environment? I mean, every scenario and simulation that I tried to do would be a disaster. So how can anyone with like 2 grams of brain in Washington even think of that? That's really I'm puzzled. I don't know what I'm missing here, because yield control in deflation environment, I would say, is a little bit easier than an inflation environment that we are underplaying, because we all know inflation is much higher than the government numbers. So what is your thought? What is the article you were reading? Is there mention of that, or everyone's just thinking it's going to be a jolly end?
No, I don't think it's going to be a straightforward jolly end. And the article that can be sent didn't even address it.
That's my point. Yeah. That's incredible.
No, I absolutely agree. And that's definitely a risk to this view. My sense is that as sort of the job market weakens, we get a slower growth environment that should put some sort of lid on inflation. I don't know if that'll work out or not, but that's the thesis. Which is why if I were to have this view, I would definitely hedge it.
Yeah, exactly. So hopefully we get a depression so we can keep the long yield down.
Yeah, I mean, one thing one last point is, if you look at oil prices, that there's something going on in the background why OPEC keeps increasing production in 2025. I think there's some element of not coercion or whatever you want to use it, effort to get OPEC to keep oil prices low, which kind of keeps inflation low. Again, this is a little bit of conspiracy theory, but I've never seen OPEC increase production so much over the last 15 years as they have done in 2025 in order to keep oil prices low.
But if you go back after Trump's meeting in Riyadh, And
Yeah.
2 days after the announcement of the tariffs, what was it called? I can't remember what was
Yeah, I mean, every week there's something going
2 days,
on, right?
yeah, 2 days after the tariff
Liberation Day.
announcements, Liberation Day,
Yeah.
the OPEC just mysteriously the next day, not two, decided to actually increase output for first time in years. So in my view, I heard some speculation, which there's some room to it. Maybe the deal was you guys pump out the oil, have lower prices, we'll make sure gold goes up. Those
Yeah.
two things are very correlated. It happened at the same time. So something was going on. I don't think they were talking about Ukraine. They never talk about the titles, head titles. It's always something else. I mean, remember, Putin, the Riyadh prince, and Trump, the three biggest energy producers on this planet, meet in Riyadh to talk about Ukraine. If you believe that, as a bridge is called Brooklyn Bridge in Manhattan, I'm going to sell you.
Yeah. So anyway, yeah, it will be a complete failure if not inflation is not going down.
Yeah.
Point taken.
I think it's politics. I mean, in my mind, I've been cautious about oil and energy because it is clear in my mind that Donald Trump would love to solve this Russia-Ukraine problem. And the best way, short of nukes, is to lower the price of oil. And I think very deliberately he wants to put pressure on Putin through lower oil prices, and that is why the Saudis are accommodating that. And you're seeing it come. I mean, I thought it was almost spooky yesterday what Trump was saying. He's like, I think NATO members ought to shoot down Russian jets.
Well, how's
they
that
fly
working?
over NATO. I mean, that is
a
very aggressive thing. And I think that he has always tried to use money as a stick to get what he wants. And I'm sorry, go ahead, Mitch. What?
Yeah, well, how is that working out for him? You want lower oil prices, then you say shoot down Russian jets. It doesn't work like that. Right now, you have at least $15 premium in the oil price because of, among other things, because of Trump's statements. So how is that going to work out? I mean, it's not working out. And
I don't know how it's going to work out. It's scary. He's definitely ratcheting up, and
what happens? What happens if Ukraine waves a white flag? And does that matter anymore? And war's over? Does that matter anymore?
I don't know how it's going to play out, but to me, I can see that I would rather own gold than oil.
Absolutely. I totally agree, because with all these factors, yeah, absolutely. I agree.
All right. Any last comments?
Thanks, Tyson. Good combo.
Thanks. It was a great call. A lot of very smart people saying intelligent things, making me look good by extension. Thank you.
Thank you. Nice to meet you all.
Thanks, everyone.
Yes.